Hello everyone. Today we're going to talk about the basic types of fuel price protection. These are financial instruments that are used to help companies that consume diesel fuel, gasoline, and other motor fuels to protect their prices on a forward basis. The purpose of this particular video is to show you basic structures. While they won't be all inclusive, they will be structures that will enable you to cap your risk, or at least gain some certainty over what your fuel prices would be on a forward basis. So there are basically three types of protection. The first level of protection is called the call option, or cap. And basically this is a type of structure that fits every particular company out there. It's a question of, does it fit their economic profile? So what I mean by that is a call option is basically a structure very similar to insurance, but it's not an insurance instrument. It is a financial derivative instrument. And the way it's similar is that you pay a premium, and for that premium you get a defined level of coverage. That level of coverage is defined by the price per gallon. So for instance, you can pay a premium for, let's say $2.50 coverage per gallon on a forward basis for the next year. And these are all hypothetical numbers, not necessarily sensitive to the market right now. So you pay an upfront premium, and basically what happens is, if on a monthly basis, if prices exceed that $2.50 per gallon coverage level, or we call it strike price, then you receive a financial payout. So as you look in the first box here, you see that in the graph you see the line here, and we've assumed that green line is at $2.50 a gallon. So once you have that structure in place, and let's just hypothetically say you've capped your risk for a year, then every single month you will settle up against the chosen index to settle against your $2.50 coverage level. So as an example, let's say that you put on a structure for March through the following April. And in that particular structure, each month you'd settle up against the $2.50 against the chosen index. So the index might be the New York Mercantile Exchange daily settlement price. And so how it would work is you would take the average of the settlement price from the New York Mercantile Exchange on a daily basis and take all those numbers throughout that month. And let's assume that in month one, in March, that those prices came to $2.75 on average. Well, in that example, you're obviously 25 cents in the money, or 25 cents a gallon higher than your coverage level. So you would receive a financial payout from the underwriter for 25 cents a gallon times the number of gallons that you contracted for. And an important note here is that it would not be times the number of gallons that you actually physically consume. It would be for the number of gallons that you contracted for up front. The premium itself is paid for up front for the entire structure, and the settlement occurs, as I mentioned, at the end of each month. The cash payout, if there's one due, is paid within the first 5 business days of the following month. So let's say that month 2, in our example, prices go to $3 per gallon. In that example, you obviously have a gain of 50 cents per gallon on your cap structure. So you would receive, in the following 5 business days after that month of April, you would receive a wire transfer for 50 cents a gallon times the number of gallons that you protected for that month. Now let's say in month 3 that prices dropped precipitously down to $1 a gallon. Obviously that's well below your coverage level of $2.50. In this particular case, you would not receive a payout. However, you would continue to buy your physical fuel at the lower dollar per gallon in this case. So the beauty of this structure, this cap or call option as we like to call it, is that you cap your prices, but it enables you to participate if the market moves lower. So your overall cost of goods sold is reduced if the market falls. This gives you budget certainty and predictability across your cost structure for fuel over a defined period. Now, structure 2 is a little bit further derivation of the call option or cap, in that in the collar structure, we set a cap, and then we also help finance that with a floor. Now, one of the big differences here, as you can see in the gray box, is there's risk under the floor. In financial nomenclature, what you're doing here is buying a call option and selling a put option. What does that really mean? What that really means is the cap, just like in the previous structure, you get coverage. If prices go higher, you would receive a payout above your cap, and let's use that 250 example as before. You might help offset the cost of that premium by putting a floor in at, say, $2. So in our example, you have a cap at $250, you have a floor at $2, and you've paid a smaller premium for that particular coverage. Now, what happens? Above $250, you receive a payout. Below $250, but above $2, nothing happens. There's no payout made either way. However, below $2, and this is where the structure is different, you are now obligated to make a payout to the underwriter. So this has an incremental risk of not only price risk that you might have to make a payout yourself, but it also has credit risk. So you have to be creditworthy by the particular underwriter to actually engage in this particular structure, just so the underwriter is secured of your ability to pay them if prices fall below $2. Now, financially, what's happening is that you've capped your risk at $250, and you've participated actually down on your overall cost of goods sold down to $2. And that's where your range of prices, or your collared prices, exist for your cost of goods sold, so between $2 and $250. Now, the third level is what we call a swap. And a swap is, you can envision that as just taking the previous two green lines that we saw on the collar and compressing those together into one line. And what I mean by that is, let's say that we had the swap at $250. So swap is also known as a fixed price financial instrument, in that above the $250, you would receive a payout. Conversely, below $250, you would make a payout. So there's no band like in the collar that you have nothing that occurs. It's either you receive a payout or you do not. Once again, that risk profile is you have to make a payout below that 250 level in the swap example. You also have that credit risk, once again, to the underwriter to make sure that you're creditworthy and ability to pay margin, daily margining, as you would in the collar for this type of structure. Now, the advantage of this structure is that, one, you get budget certainty as you do with all of them, and you know exactly the price that you're covered at. One of the unpalatable things about this structure is that the risk, as in the collar. If it goes below it, you're obligated to make the payout. So you just want to be to know up front that risk exists. Probably the biggest advantage that companies, and we tend to see this with large companies that participate in this structure, is that the swap has no upfront cost to it. It's a zero cost structure. So it's attractive from a no cost up front, but it could have a payout later on. So those are the basic three structures that we implement in the markets, and customers tend to vary depending on what their level of interest is and their economic profile as to which one they choose. They tend to all be subject to a call option that would fit, but the cost might not be palatable for them, and they have to determine that. But it also gives the greatest flexibility in terms of participation as the market moves down. The collars and the swaps, conversely, lower the cost up front, but they have a different risk profile. It's important to note that the trading of derivatives such as futures, options, and swaps may not be suitable for all investors. The risk of loss in hedging our trading commodities can be substantial, and Stabilitas Engergy assumes no liability for the use of any information contained herein. Past performances are not necessarily indicative of future results. Neither the information nor any opinion expressed shall be construed as an offer to buy or sell any futures, options, or futures contracts, or over-the-counter swaps or options on swaps. Information contained herein was obtained from sources believed to be reliable, or is a reasonable assessment of that information, but is not guaranteed as to its accuracy. Reproduction or forwarding without authorization is forbidden. All rights reserved. For contact information, feel free to call me or email me, Tripp Dunman at Stabilitas, and you can see my contact information there. Thank you, and we look forward to our next video. Thanks for joining us.